MPW is down 60% year to date, and every time we review medical properties trust on the channel, the stock seems to go lower and lower. But are we now looking at a massive opportunity, or is this an obvious trap? Now we can see the yield is at around 13%, and today we want to find out whether we should be taking advantage of this company that was at $14 at its 52-week high. There is a lot we want to run through in today's episode. We want to look at that dividend safety. Will there be another dividend cut this year? It is looking like there is a possible chance with this dividend safety score. We're going to take a look at the video that the CEO did drop in October to the shareholders with a lot of useful information. We're also going to run through what the market and institutions are doing in terms of whether they're buying or selling. And as always, we will look at the competitors. Is this an issue that we are seeing in the healthcare industry, or is this just relating to MPW? We will look at the total return performance, and as always we will briefly touch upon their top line revenue as well as their bottom line net income growth and their most latest quarterly report, looking at the safety of the company's balance sheet, total cash versus total debt. And don't forget, we will run them through our stock valuation model, getting to our intrinsic value and finding our acceptable buy price. Now, let's start off very quickly. It is down 60% year to date, which is very, very poor. And even over the last 10 years, we can see it down around 66%. It did hit its peak just before that COVID crash at around $24. So is there a chance to revisit that nearly 6 times the current trading price? And with that, the current yield is sitting at 13%. Is this one that we can see this yield on cost grow to 20%, 25%? Or will we be looking at this a few months from now, seeing this at 3%? So let's take a deep dive into the company. Let's start off with an article that was released, in fact, last month. Just something to note with 2 analysts dropping their price target. We can see Wells Fargo downgrading MPW, announcing a $4 price target, as well as Seversky, another Wall Street analyst, essentially lowering their price from $7 to $4. So it does look like the analysts are not looking favorably to this company, dropping it down to around $4. And we can see the current trading price sitting at $4.61. Now, what exactly are the institutions doing? Well, we see around 76% institutional ownership, around $830 million worth of sales of the company over the last 12 months. But interesting to note, for a company that has fallen so hard, institutions are buying more shares than they are selling over the last 12 months, with the most significant buy being in Q2 of 2023 at around $686 million versus $286 million sold. So it is interesting to see that institutions over the last 12 months have typically looked to bought the shares rather than sell. One thing to note though, what has seen from November 9th, they did release a very, very short article just stating that they are declaring their regular dividend. So their next dividend to be paid on January the 11th, 2024 will be 15 cents per share, which is what we are expecting. So just something to ease pressures off those who do believe a dividend cut is coming. So far, there is nothing to note based on that information. Now, something just to note that we will just play a few seconds of in terms of the CEO, Edward K. Aldag, and he's just talking about the shareholders. We have watched this video. Do go and watch it if you want to see. We have seen it's only 8 minutes. If you are a shareholder, it may be worth it. But what he's trying to say in this message to shareholders is there is no need to worry, and that he, as CEO and also someone who owns shares in the company, is doing everything he can to effectively bring this company back to what it should be in terms of the share price for the shareholders. And he owns a lot of shares himself. So let's play just a few seconds.
Appreciation to all the shareholders who continue to place their trust in our company. We do not take it for granted. We pride ourselves on maintaining the high road, even as our share price has come under pressure from others who stand to benefit financially from such a decline.
So what she's stating there is exactly that there are essential institutions or hedge funds that are shorting the price of medical properties trust, that they are effectively gaining money whilst the share price is dropping.
However, I would be remiss not to acknowledge the real toll this has taken on people who have invested their hard-earned savings with us. As a large shareholder myself, with significant interest tied to the success of this company, please know that I hear and feel every one of you. So with that in mind, it's time you heard directly from me all the reasons I remain confident in NPT's proven business model and ability to create.
So if you do want to watch the other video, I do recommend it. It isn't the longest and he does touch upon a lot of points as to why he believes this company will go back to what we saw the share price over the last 12 months and beyond in the prior period. Now, a very useful summary at the 110 mark for those that do want to hear just a few seconds, which I do find as valuable.
MPT has grown into the second largest owner of hospital real estate in the world. Our business model has contributed to the clinical excellence in hundreds of hospitals globally. To put some numbers around that, our portfolio currently includes approximately 44,000 hospital beds in over 400 properties across 10 countries. Today, our total asset value stands at $19.2 billion, having grown 118% since the end of 2018.
So there's a lot of information there, and like I said, do go on that website and watch the full video if you are interested. So let's jump into some comparisons to see how companies in this sector have been hit, and we have quite a few that are well known in the space. So year to date, including those dividends reinvested, MPW is down 56%, the worst performer. So what we can see, it is important to note that it isn't the industry as a whole. If we do look at some other ones, CTRE positive 28% year to date, NHI 7.12 and SBRA up 24%. So it does look like it is an issue that is directly related to the MPW business. Now, over the last 5 years, if we take a look, they are still down minus 61%. And remember, this includes those dividends reinvested with, again, CTRE positive and also SBRA. Remember, though, we never look at any of these in isolation, as past performance is never indicative of the future, but it is always good to have as one added layer. Now, before we touch upon the dividend safety and some important financial metrics, for those that are new, let's just run through the top line growth year on year. Now, typically for REITs, 5 to 10% is what we're after. 800 million in 2018, 1.6 billion in 2022. So positive, they have increased their top line by double over the last 10 years. So very positive to see. And on top of that, on a more granular level, we do see some nice increases year on year. A smaller increase from 21 to 22, but nonetheless moving in the right direction. And we'll touch upon the last 10 years in percentage too. Bottom line net income, well, 1 billion in 2018, 903 million in 2022. So whilst they have increased their top line by double, in fact, their bottom line has dropped by around 10%. On a more granular level, what we do see though, 2018, the drop to 2019 before picking up nicely. So it has been increasing from 2019 onwards. So that is still positive to note. And then when we take a very quick look at the health of the company, total cash versus total debt, 821 million in cash in 2018. Latest quarterly report, 340 million. So they are sitting on less cash now than they did 5 years ago. And when we compare that numerically and directionally to their total debt, 4 billion in total debt in 2018 with a 2.5 increase in their latest quarterly report of 10.2 billion, which is one of the reasons why we did see that initial dividend cut in the year. But again, something just to note, and we will take a look now at the dividend metrics to see and understand that net debt to EBITDA, which closely correlates. So Medical Properties Trust, it has a dividend safety score of 20, making it very unsafe, yield of 13%, with a market cap of 2.8 billion, making it a mid-cap company. Now, in terms of some key metrics for those that see a recession inbound, they in fact cut their dividend during the 07-09 recession. Recession sales, negative 5%. However, it was above the average growth of companies in the S&P 500. And interestingly, whilst it had above average growth, it did have a worse performance, underperforming the S&P, which was down 55% versus MPW's negative 76%. Dividend growth, yes, we saw that dividend cut of a negative 48% in August 23, and there is still rumours that we will see another one this year. The last 5 years, 4%, so in line with inflation that I always advocate as a minimum, and last 10 years, 4%. So whilst it isn't bad, it is keeping up with inflation. If you are able to lock in a 13% yield, and it does keep up with inflation with no dividend cuts, then it could be a well sorted after investment. Now, dividend yield theory states that the company is undervalued when that current yield sits above the 5-year average. So we have our first sign of undervaluation. Bearing in mind, as always, we're not looking at any model in isolation and drawing our conclusions towards the end of the episode. Forward P to AFFO 4 versus 14.5, so another sign of undervaluation, and we can see the sector PE significantly higher at 12.9. Now, as I mentioned at the beginning of the episode, yes, it is towards that 52-week low, but remember, 52-week low is not a signal for undervaluation. Likewise, 52-week high is not a signal for overvaluation. Now, free cash flow is what we always look at. For REITs, however, we tend to focus on the adjusted funds from operations, as free cash flow is more volatile. Below 95% for medical REITs, which is what we can see for the large part of the last 10 years. 21-22 at around 82%. It is expected to fall in 2023, which is positive to see, does give faith in that dividend being stable for now. Adjusted funds from operations per share, 93 cents in 2013, 142 in 2022. So it has increased over the last 10 years. Not as consistent as we would like to see, but the positive is that it has increased. But do note 2023, it is expected to fall slightly, and we will be getting 2023's annual reports at the beginning of 2024 to dissect and discuss on the channel. Now remember, sales growth for REITs 5 to 10%, and it is positive to see up to 2021. We have seen that. 2022, it has dropped slightly with the trailing 12 months at negative 12%. So when we do get 2023, it will be important to see whether they have been able to boost that back up to the double digits we expect to see from MPW. Total shares then numerically 250 million. It has seen some nice growth over the last 10 years at 1.58 billion in 2022. And typically with REITs, we do see this. Whilst we love it as investors when companies do share buybacks, returning excess cash to our pockets, with REITs, we typically see the opposite. They do share issuances, which effectively dilutes your position as a shareholder. The reason for this is so they can fund, as we see here, property acquisitions, as they do retain little of that internally generated cash flow. Remember, given that majority of that is paid out in dividends. So this is very typical for REITs in terms of the share issuances and share outstanding increasing. Now, ROIC, one of my 7 golden dividend metrics. If you're familiar on the channel, 10% or more is what we look for. It does mean management are able to effectively allocate their capital. 3 to 5% for REITs. So this is very positive for REITs. It is on the higher end of the minimums that we look for REITs. So that is good. Gives us faith in management. And in terms of their operating margin, very nice to see that this is in the high 60s. The higher that operating margin, then in theory, the higher that bottom line should be. But do note that the trailing 12 months is 40%, so we may be expecting a small drop in the 2023 report. Now, one of the reasons why we do see that dividend safety score at very, very low is all down to the net debt to EBITDA, which is the earnings before interest, tax, depreciation, amortization. What this signals is the number of years it would take the company to pay off their debt net of cash on hand. And it looks like it is above that 6 maximum we look for year on year. And do note 2023 it is expected to go even higher, in fact the highest we've ever seen. Hence why I do believe that there could be a possible dividend cut coming, or definitely no increases year on year due to this very, very high rate. So that is our analysis of MPW, and now we'll jump into the stock valuation model. And as always, if you do enjoy the content, value is being provided, hit that like button. In fact, smash the like button. It helps increase the community, getting this video out to more investors. And do hit that bell button and subscribe if you are interested in these videos on a more regular basis. And finally, if you want to grab a copy of the stock valuation model we're about to run through to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. Now, typically with REITs, we don't use the Graham's valuation formula. It isn't appropriate, so we tend to ignore it. But if we were to use it, this is what we would do. We'd have their stock ticker symbol. Now, earnings per share, one thing to note, their earnings per share for the trailing 12 months, which is what we typically use, is negative, and therefore this model would be redundant. So what we have done is we've just taken the average of the last 2 years plus the trailing 12 months to give 0.843. Growth rate per analyst estimates with that current yield on AAA corporate bond would then give us our intrinsic value. So using the first model, we have the multiples valuation model for REITs. We have their stock ticker symbol, their company name, stock price, P to AFFO multiple. We have the average and the P to AFFO of MPW, giving a stock price of $14.74. Now, when we take a look at the 52-week range, we do see it's right there at that 52-week high, showing signs of undervaluation in the current market. But as always, do remember we're not looking at any of these models in isolation. Now, the dividend discount model, we have the yearly dividends. We did see that very unfortunate dividend cut for the investors. So average growth rate over the period is negative 7.43%. Forward looking, I have gone for 0.25%, but remember, as always, if you're more of an optimistic or conservative, you can grab a copy of the model and play around with these figures. So this gives a DDM price of $7.76, which again shows some nice upside to the current trading price at just over 50%, again undervaluation in the current market. We then move on to the third and final model with the DCF model, where we have the average growth rate at around 2% forward looking per analyst estimates with our discount rate. We get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, arrive at the equity value, and we get the shares outstanding. Divide by that, we get the DCF price of $9.21. Again, strong upside over 100% on the current trading price, so we have signs here of undervaluation. Remember, as always, if you do enjoy the content, value is being provided, do hit that like button, do subscribe and hit the bell to be continually notified of these videos as they drop. So the intrinsic value coming to $10.57. Now remember, with the current price, we do start off, as always, with a margin of safety of 10%, wide moat, strong financial metrics, good forward-looking data. It really comes down now to the individual investor's preference. Those looking at 20%, it is a buy up to 846. Those at 40%, 30% in fact 740, 40% around 634, and 50% at 529. Those looking at 60% would have to wait. So you are right now getting a margin of safety based on our estimates of 55%. What do Wall Street say? Well, they believe the share price to go up by around 50% to $7.22. So they do believe there to be some nice upside to the current trading price. And if there is no dividend cut, you are locking in a very high yield with your yield on cost only ever growing. As always though, do let me know your thoughts in the comments below. Is MPW one that you hold? Is it one you recently sold as the share price did take a very large hammering? Or if you're just on the sidelines, let me know your bullish or bearish case for the company. As always, if you enjoy the content, do hit that like button. Let me know you're enjoying this value that is being provided. Hit the subscribe and bell if you haven't already joined our lovely community. And finally, if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, or if you want to run through MPW again based on your own estimates, then do click on that pinned comment below. As always, have a great day, catch you on the next episode, and take care.